Good day. This is Elisna van der Westhuizen from the Accounting Standards Board. In this recording, we will look at the importance of disclosing information on significant judgments and uncertainties. Please take note of our standard disclaimer. That is, if there are views and opinions expressed in this recording, it is my view and not the official position of the ASB. So let's start with significant judgments and what are they? From our conceptual framework, preparers applying their professional judgment are responsible for ensuring that information that meets the objective of financial reporting and achieves the qualitative characteristics is provided in the general purpose financial reports that they as preparers prepare. The need for management to apply judgment is pervasive in the conceptual framework and throughout the standards of GRAP. There are many examples where management would need to apply their judgment in preparing the financial statements. One of the qualitative characteristics in the conceptual framework is faithful representation. This requires that to be useful in financial reporting, information must be a faithful representation of the economic and other phenomenon that it purports to represent. However, as acknowledged in the conceptual framework, the economic and other phenomena represented in general purpose financial reports generally occur under conditions of uncertainty. Information included in general purpose financial reports will therefore often include estimates that incorporate management's judgment. Caution will need to be exercised when dealing with uncertainty. It may sometimes be necessary to explicitly disclose the degree of uncertainty in financial and non-financial information in order to faithfully represent the economic and other phenomena. We will look a bit later in the slides at disclosures that are specifically required in the standards of GRAP. It's also just important to note that the use of reasonable estimates is an essential part of the preparation of financial statements, and the use of estimates does not undermine their reliability. Let's look at some examples. So as acknowledged by the conceptual framework, there are many areas of uncertainty, and these require management to make estimates in order to provide information in the financial statements. And this, of course, involves judgments that management should make based on the latest available reliable information. As an estimate requires judgment, there may be changes in circumstances which may require the need to revise estimates that have been made. So, for example, when there's been a change in circumstances on which the estimate was based, or there may be new information or more experience that come and become available over time, which management considers and they need to change the estimate. This is a normal part of financial reporting and should not be something that management shies away from. So, for example, let's look at a few areas where judgment and estimates are applied under conditions of uncertainty. Tax revenue that's due to government, and with that, where there is a receivable linked to the revenue, management may need to estimate the bad debts that come from uncollected revenue. Inventory obsolescence, not all entities have inventory. If an entity does have inventory, it needs to assess whether there is any obsolescence. Then the fair value of financial assets and liabilities. These assets and liabilities are all initially measured at fair value, and some of them are subsequently measured at fair value as well, which means an ongoing estimate needs to be made as long as those are recognized. Then the useful lives of depreciable assets is another area that most entities would be familiar with, and this needs to also be done on an annual basis. There are also other areas where judgment is required, and quite importantly, we'll first look at materiality. So this is management's judgment of what information is important for users in order to understand the context and the story of the entity, and to be able to understand the financial position, performance, and cash flows of the entity at the reporting date and for the reporting period. Some materiality is a pervasive concept, of course, that applies throughout the reporting cycle and to all information in the financial statements. It starts with determining what accounting policies are significant, what those policies should be, as well as then reporting in the financial statements what information should be provided and how should that information be provided. Going concern is a fundamental principle in preparing financial statements, and that is another area of judgment for management to assess whether the entity is a going concern and will continue with its operations in the foreseeable future. More importantly, I think in the public sector is the need for management to provide information about any significant uncertainties that may exist about an entity's ability to continue as a going concern. In the public sector, entities usually do meet the going concern assessment, but there are often significant uncertainties that need to be disclosed. And then linked to materiality is the presentation of financial information in the financial statements. So this is judgment in presentation that includes the items to aggregate or disaggregate, or what information is appropriate for the face of the statements compared to the notes. Another area could be determining what's an appropriate name for an item that is presented separately in the financial statements. So many areas of judgments when it comes to presentation. So let's look at the importance of disclosure. I think as the Accounting Standards Board, we often hear from preparers that they have difficulty in applying judgments and making estimates under conditions of uncertainty. It is difficult just because of the nature of what is required of management, and it is not always easy to clearly explain what management's thought processes were. So this is why it's so important to explain in the financial statements what management had considered, what assumptions have been used by management, etc. And this is to allow users to understand what management had considered and assumed, so that they can use the information in the financial statements for decision-making purposes, as well as to hold entities accountable. So instead of this being a disclosure that preparers shy away from, I think it is disclosure to be embraced and to be seen as a tool by management to explain to users what they have done. So specific requirements in GRAP 1 that deal with judgments and significant uncertainties. GRAP 1 paragraph 132 requires an entity to disclose the judgments that management has made in the process of applying the entity's accounting policies that have the most significant effect on the amounts recognized in the financial statements. Then paragraph 135 requires an entity to provide information about the key assumptions concerning the future and other key sources of estimation uncertainty at the reporting date that have a significant risk of causing a material adjustment to the carrying amounts of assets and liabilities within the next financial year. So these are two specific requirements from GRAP 1. But there are further requirements at standards level that also speak to judgments and areas of significant uncertainty and estimates as well. So it is important to understand the requirements that relate to the items that you have in your financial statements. So I think just as a key takeaway, disclosing sufficient information about management's significant judgments and uncertainties is important as it enables users to understand the information in the financial statements, and it is a tool for management to communicate with users and to enable them to understand. So after this, I hope you have a better understanding of the importance of disclosing information on significant judgments and uncertainties. If you found this helpful, please like, comment, and share. And remember to subscribe to our YouTube channel to get our latest videos. Thank you very much.